Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Shamir Karkal, CEO of Sila, to discuss how the macroeconomic environment is impacting the fintech space, crypto, and advice for young entrepreneurs experiencing their first downturn. It is great to have you with us. Shamir, welcome to Trade Talks.
Thank you for having me, Jill. It's a pleasure to be here.
All right, you got it. I hope I pronounced it correctly. Sila or Sila? I should have asked.
Sila, that's totally fine.
I realized that as soon as I said it, but let's get into the meat of the conversation here. We are in a bear market right now. Inflation is high. A recession might be looming in the near future. This is a very different macroeconomic environment compared to the recent past. How has this started to affect the fintech industry, and what can we expect going forward?
Well, there's a bunch of public market fintech companies out there, right? And a lot of them went public in the last couple of years. Their stocks have been among the hardest hit in this bear market sell-off, right? Like some companies are down 70+% from their peaks from last year. And that's beginning to feed into late stage private market valuations and even into mid-stage private market valuations, right? So if you're out there raising around for a fintech or a crypto company, and honestly for any tech startup out there, the fundraising environment in the last 2 months has gotten a lot harder than it was historically. And that's just a reality that everybody has to live with.
How has this started to impact crypto businesses?
Crypto has been part of the sell-off as well, and actually quite correlated. And what we're beginning to see is that it's getting harder and harder to fund new crypto businesses. Crypto funding is somewhat different from the traditional VC funding that fintech startups go through. But all those sources of capital, whether it's token sales, whether it's grants, whether it's investments from VCs, all of those have gotten tighter as well. And there's a lot of people out there who are going to struggle to raise money in very different ways over the next 3-6 months from what they did a year ago. Some of that is probably a good thing, though. I mean, there has been a lot of froth in the market, whether that's in crypto, whether that's in fintech, whether that's in tech startups, and I think it just feels hard compared to how easy it was last year. If you look back on it over an 8 or 10 year horizon, this is really just getting back to how things were in 2018 or 2019. And in 2018, 2019, we didn't think that the world was a bad place. We thought it was actually a good time back then. So it's just coming off the high. It's not necessarily bad in absolute terms.
Yeah, and how have private equity, you'd mentioned before, the private equity and VCs have changed their strategy over the past couple of months because of that. How so? Are they dialing back on what they're willing to invest in, or just like smaller fintech and crypto companies? Are they just waiting to ride out and see what happens within the market?
So one thing that's happening is that people have been caught a little bit by surprise by the speed of which, Q4 was still full on, pedal to the metal growth mode. And now halfway through Q2, where there's real serious talk of a recession. So, it's happened somewhat quickly for people. And a lot of folks are spending a lot of time working with their existing portfolio companies and saying, hey, you raised a giant round at a crazy valuation, what seems now like a crazy valuation, I should say, 6, 12, 18 months ago. You might grow rapidly, but with multiple shrinking, you might struggle to raise your next round despite growing rapidly. And so we need to help you work through that. So people are focusing internally on their existing portfolios a lot in the last couple of months. And then I think people are rediscovering discipline, where folks typically had check sizes that they wrote into companies at a certain stage with metrics around, whatever it is, revenue, growth, and all of those things. It felt like last year, all of that went out of the window. Right? And you saw very large late-stage companies doing what were effectively seed rounds at large late-stage company valuations. And now you see that's been dialed back completely. So people are talking again about looking at sector fit, stage fit, and all of those things, which was the norm again in 2016 to 2019. It was not the norm in 2020 and 2021.
Yeah, Shamir, I would agree with you. I think we need to see this reset here as well. I think, even if it's a responsibility to public investors, making sure that there's quality companies coming to market so that they can all participate. What advice should be given to young entrepreneurs who might experience their first economic downturn? And we have a generation of young investors and entrepreneurs who have not seen prolonged volatility in the markets. What's the best way to prepare for it?
One thing I think is to realize that you can't escape the reality, and so burying your head in the sand and saying things are magically going to get better next week or next month, that they might, but they're not going to get magically massively better. We're not going back to the boom of Q3, Q4 in a day or a week, maybe in a year or two, right? It's always possible. So being realistic about where the market is right now is I think just the first thing. The other thing to realize is that this isn't really bad in absolute terms. This is only bad compared to where we were last year, right? So be much more realistic about what your goals and aims are. Understand that raising rounds is going to take much longer, and that the traditional metrics are back, right? And it's important. But then also realize that the fundamentals that people were looking at when they placed those big bets last year haven't changed, right? So if you look at fintech and crypto, the financial services industry globally is a multi-trillion. It's like 15 or 20 trillion industry, all of it across the globe. And all of fintech and crypto combined, starting from PayPal 25 years ago to Sila today, all of it combined is not even 2% market share. And so the real opportunity here is that kind of generational change in infrastructure, in businesses, and operating models that the internet is bringing to these old gigantic industries. That is still happening, right? Like you look at a lot of those public market companies whose stocks have gone down. Some of them are still growing 30, 50, 70% year on year. So you're like, they just need, as long as they keep doing that, the markets will come back, and people will realize that by 2030, fintech and crypto as an industry will be like 10x larger than it is now. But so it's not ahead of itself. It's going to get behind itself, and there's going to be a wave. You have to ride it out and keep building for the long term.
Right. And to your point, perhaps there were a number of trends that were accelerated, let's say 3 to 5 years as a result of the pandemic. So I think that was a factor as well. But generally speaking, Shamir, it almost sounds like if you ask the question, is it better or worse to start a company during an economic downturn? I mean, if you can make it now, in theory, should be easier when things do turn the corner. What are your thoughts there?
I agree. I think you look back and you look at some of the largest companies of today, right? Whether it was Airbnb and Uber and all of those giant companies that defined kind of the last 10 years of startup growth. They were all started in the 07 to 2011-12 period, which was coming off the Great Recession, right, or in the middle of the Great Recession. If you look at the early round valuations of some of those companies, it's just so far from what's been the norm for the last 2 years. So I think starting companies in a recession is harder from a fundraising perspective, because it's harder to convince investors to give you money when there's fewer investors doing fewer deals, right? But from every other perspective, it's actually probably easier. There's going to be less competition. It's going to get easier to hire engineers. The level of noise in the market is probably going to reduce, so you can stand out more easily. So all of these other business building things are probably easier in a kind of recessionary or not recessionary, but at least in a slower environment than they are when things are white hot, right? So if you care about long-term business building, this might be a great time to start a company. If you care about short-term fundraising, it's not such a great moment. But I'm of the belief that fundraising follows the business building, right? And as an entrepreneur, as an executive, as a builder, you should stay focused on the business building and how you get to long-term success over a 3 to 10 year horizon, not what's going to happen in the next 3 weeks to 6-12 months, right? And so I think that's I feel like that's going to get more rewarded now. And yeah, as I said, business building is probably easier, fundraising a little bit harder. Still not a bad time to start a business, maybe a better time.
Yeah, excellent insight, Shamir. We appreciate it. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me. It was a pleasure, Jill.